2 different decades, 2 different crises, but the exact same pattern. The fall of Lehman Brothers, then Silicon Valley Bank, and then First Republic wasn't a series of isolated accidents. It was a predictable, 6-stage demolition, almost like we're reading from a script. And in this video, we're going to show you the blueprint for financial disaster that regulators seem to miss every single time. And the most terrifying part? History says this pattern is guaranteed to repeat itself. A bank doesn't just fail overnight. It's not a random event like a lightning strike. It's more like a controlled demolition, where structural weaknesses are built up over years, hidden behind a facade of success. And then, when a trigger is pulled, the entire structure implodes. For decades, we've been told each collapse is a unique tragedy. Lehman Brothers in 2008 was about subprime mortgages. Silicon Valley Bank and First Republic in 2023 were about rising interest rates and social media. That's the official story. But what if that story is wrong? What if these aren't isolated incidents, but predictable outcomes of a recurring cycle? Today, we dissect that cycle. We will break down the 6 stages of a modern bank collapse using the ghosts of these 3 failed giants, Lehman, SVB, and First Republic, to illustrate each step. You'll see how a hunger for growth becomes an addiction to risk, how specialization becomes a fatal concentration, and how the very people in charge become blind to the abyss in front of them. By the end of this, you won't just understand what happened. You will understand the playbook, a playbook that has been run before and will be run again. This is the anatomy of a financial disaster. Stage 1. Rapid growth and risk accumulation. Every story of collapse begins with a boom. This is stage 1 of every collapse: rapid growth and risk accumulation. This is the phase where a bank's success is measured by how fast it can grow. The stock price is soaring, assets are ballooning, and the bank is the darling of Wall Street. But beneath the surface, the rot is setting in. This relentless pursuit of growth always involves embracing higher and higher levels of risk. Let's look at Lehman Brothers. In the mid-2000s, Lehman was a 158-year-old institution that decided to dive headfirst into the booming housing market. It aggressively expanded into subprime mortgage-backed securities, and to fuel this, Lehman leveraged itself to the hilt. By 2007, its leverage ratio was over 30-to-1. Let that sink in. For every $1 of its own money, it had borrowed 30. This supercharged their profits as long as the market went up. It was celebrated as genius, but it also meant the firm was balanced on a knife's edge. Now, let's fast forward to the 2020s and Silicon Valley Bank. As the tech industry went into hyperdrive during the pandemic, cash flooded into the startups SVB catered to. Between 2020 and 2022, the bank's assets nearly tripled to over $201 billion. This wasn't just growth, it was a rocket launch. Like Lehman, SVB was celebrated. But to generate a return on this mountain of cash, SVB had to put the money to work, leading it to take on a very specific, and as it turned out, fatal risk. Our third case, First Republic, followed a similar script but targeted the rich. Their strategy was simple: offer wealthy clients exceptionally cheap jumbo mortgages, and in exchange, those clients would bring their massive deposits to the bank. It worked. The bank grew at a phenomenal pace. It was seen as a premium, safe institution. But this expansion was fundamentally a bet that the low interest rate environment that had prevailed for a decade would last forever. So here's the pattern in stage 1. 3 different banks, 3 different eras. But the story is the same. Lehman, fueled by debt, chased the housing boom. SVB, flooded with tech cash, chased returns. First Republic, courting the rich with cheap loans, bet the farm on low rates. All three were praised for their growth, but in reality, they were all accumulating massive, hidden risks, setting the stage for their own demise. Stage 2. Asset concentration and overexposure. If Stage 1 is about accumulating risk, Stage 2 is about where you place it. This is the stage of asset concentration and overexposure. It's the financial equivalent of putting all your eggs in one basket. A healthy bank is diversified. A bank destined for collapse does the opposite. It develops a niche that looks like a brilliant strategy, but this concentration creates a single point of failure. When that one basket breaks, everything is lost. For Lehman Brothers, that basket was American real estate. As the housing bubble inflated, its balance sheet became grotesquely overconcentrated with mortgage-backed securities, many of them subprime. As long as housing prices went up, these assets were gold, but they were also incredibly illiquid. When the market turned, Lehman found itself holding a portfolio of assets that nobody wanted and nobody could even properly value. Its specialization had become a trap. Silicon Valley Bank's concentration was twofold. First, its depositors were almost all tech startups and VCs, all part of the same herd. Second, to make money on those deposits, SVB invested heavily in long-term U.S. Treasury bonds, a massive, unhedged gamble that interest rates would stay low. So, SVB was exposed on both sides. Its funding came from a single industry, and its assets were concentrated in a single bet against rising rates. It was a pincer movement waiting to happen. First Republic's concentration was just as dangerous. Like SVB, it had a concentrated base of wealthy depositors with balances far exceeding the $250,000 FDIC insurance limit. This created an enormous pool of uninsured deposits. On the asset side, its portfolio was dominated by the very thing it used to attract them: low-interest rate jumbo mortgages. These loans were profitable when rates were near zero, but when rates rose, they became low-value assets. The bank was borrowing short-term from its depositors and lending long-term at fixed, low rates. A classic banking mismatch practiced on an epic scale. The pattern is chillingly clear. Lehman became a hedge fund for the real estate market. SVB became the central bank for the tech bubble. First Republic became a specialized lender to the rich. Each bank's perceived strength, its niche, was in fact its greatest weakness. They weren't diversified financial institutions. They were highly leveraged, one-trick ponies. And in finance, a one-trick pony rarely survives a change in the weather. Stage 3. Deterioration of risk management and governance. A bank can have a risky strategy, but it's Stage 3 that makes a collapse inevitable: the deterioration of risk management and governance. This is the stage where the internal watchdogs, the people meant to sound the alarm, fail. It's a culture of hubris, where warning signs are ignored and short-term profits are prioritized over long-term stability. In this stage, all safeguards break down. At Lehman Brothers, the failures were legendary. The firm was famous for its aggressive, risk-taking culture, led by CEO Dick Fuld. As Lehman plunged deeper into toxic real estate, its own risk management department was reportedly sidelined. The board, stacked with individuals who had little direct banking experience, failed to challenge the firm's reckless direction. In the pursuit of ever higher earnings, the firm's leadership was essentially driving blindfolded at 100 miles per hour. The people with power would rather see the firm burn than give up their bonuses. Sound familiar? The case of SVB is perhaps even more egregious because the risk was so simple: interest rate risk. This is Banking 101. Yet, As the Federal Reserve began the most aggressive rate-hiking cycle in decades, SVB did stunningly little to hedge this obvious risk. The Fed's own postmortem called it a textbook case of mismanagement. For 8 months in 2022, a critical period, the bank astonishingly operated without a chief risk officer. Let me repeat that. A $200 billion bank, facing a rapidly changing rate environment, had no one officially in charge of managing risk. It was a catastrophic failure of the most basic duties of bank stewardship. First Republic's story echoes SVB's. Their entire model was a ticking time bomb if rates ever normalized. A competent risk management team should have been stress testing this relentlessly. Yet, like SVB, they were caught completely flat-footed. The risk was not a black swan. It was a foreseeable, cyclical change in monetary policy. Their risk management had failed to account for the bank's primary existential threat. The leadership was so committed to its growth model that it ignored the changing world around it. Here is the common thread: negligence at the highest levels. At Lehman, it was a culture of hubris. At SVB and First Republic, it was an almost unbelievable failure to manage one of the most fundamental risks in banking. In all 3 cases, the board and senior management failed in their most basic duty: to protect the institution from itself. The ship was sailing directly towards an iceberg that was visible to anyone who cared to look, and the crew was busy celebrating the speed of their voyage. Stage 4. The trigger event. For a bank with the vulnerabilities built up in the first 3 stages, its fate is already sealed. Stage 4 is the push that sends it over the edge, the trigger event. This is the external shock that exposes the internal rot. The trigger is not the fundamental cause of the collapse. The trigger is simply the spark that ignites the gasoline. For Lehman Brothers, the trigger came to a head in March 2008 with the emergency rescue of another investment bank, Bear Stearns. Its failure sent a shockwave of fear through the system. Suddenly, everyone began asking, "Who's next?" All eyes turned to Lehman. The trigger wasn't just the housing market decline itself, but the failure of a peer, which shattered the illusion that major financial institutions were invincible. This created a crisis of confidence that put Lehman squarely in the crosshairs. For Silicon Valley Bank, the trigger was entirely self-inflicted. The underlying pressure was the Fed raising interest rates, which had decimated the value of SVB's bond portfolio. For months, this was an on-paper loss. But on March 8, 2023, SVB made a fateful announcement. It declared it had sold $21 billion of its securities at a nearly $2 billion loss and needed to raise new capital. This announcement was the trigger. It was a public admission that the bank was hemorrhaging money. The statement was intended to reassure the market, but it did the exact opposite. It was a giant, flashing red light that screamed, "We are in trouble." The trigger for the First Republic was the most brutal of all: contagion. Its trigger was the collapse of Silicon Valley Bank just days earlier. First Republic shared SVB's key vulnerabilities: a business model dependent on low rates and a heavy reliance on wealthy, uninsured depositors. The moment SVB failed, a wave of panic washed over the financial sector. Depositors, investors, and analysts looked around for the next domino, and their eyes landed squarely on First Republic. It was the logical next victim. The pattern in Stage 4 shows how different shocks can ignite the same tinder. For Lehman, the fall of a competitor. For SVB, a clumsy announcement that confirmed the market's worst fears. For the First Republic, pure, unadulterated fear. In each case, the trigger transformed a chronic problem into an acute crisis. The slow-motion train wreck had just hit a wall. Stage 5. Loss of confidence and the bank run. This is the stage where the collapse becomes an unstoppable force of nature. Stage 5 is the loss of confidence and the bank run. Banking runs on a single, intangible asset: confidence. When that belief shatters, the system breaks. A bank run is a self-fulfilling prophecy of fear. Once it starts, it is almost impossible to stop. The run on Lehman was a run by its peers, an institutional bank run. Its depositors were other financial institutions, hedge funds, rival banks, who provided Lehman with short-term funding. After the Bear Stearns crisis, these counterparties lost confidence. They started demanding more collateral and pulling their business. The final, fatal run came in the days leading up to its September 15th bankruptcy. Confidence had completely evaporated. It was a bank run conducted not by people at ATMs, but by traders on Bloomberg terminals. The run on Silicon Valley Bank, however, was the first digital bank run, accelerated to terrifying speeds by technology. Following SVB's disastrous announcement, the highly networked Silicon Valley community sprang into action. Prominent VCs sent emails and Slack messages advising their companies to pull their money out. The panic went viral. Because of online banking, they could move hundreds of millions of dollars with a few clicks on a phone. The result was staggering. On Thursday, March 9th, depositors attempted to withdraw $42 billion in a single day. It was not a bank run. It was a bank sprint. First Republic's bank run was a brutal demonstration of contagion. The panic from SVB jumped directly to the First Republic. They started pulling their money out immediately. The situation grew so dire that a coalition of America's largest banks deposited $30 billion into the First Republic to signal confidence. It was a historic rescue attempt. But it failed. The fundamental loss of confidence was too deep. The bank later revealed it had lost over $100 billion in deposits. Even a $30 billion lifeline from the most powerful banks in the world couldn't restore broken confidence. The pattern of Stage 5 is the death spiral. For Lehman, a months-long institutional strangulation. For SVB and First Republic, a digital flash flood. The core lesson is that confidence, once lost, is nearly impossible to regain. And in the digital age, that loss of confidence can spread at the speed of light. The dam had broken. Stage 6. Regulatory intervention and collapse. This is the final act. The bank has failed. Stage 6 is regulatory intervention and collapse. At this point, the government must step in to manage the failure, protect insured depositors, and try to prevent the collapse from taking down the entire system. The intervention for Lehman Brothers in September 2008 is one of the most debated decisions in financial history. After frantic negotiations to find a buyer failed, the U.S. government made a fateful choice. Having already bailed out Bear Stearns, Fannie Mae, and Freddie Mac, they decided to draw a line in the sand. There would be no bailout for Lehman. On Monday, September 15th, Lehman Brothers filed for the largest bankruptcy in U.S. history. The immediate effect was catastrophic. It triggered a full-blown global financial panic, freezing credit markets and turning a serious recession into the Great Recession. The regulatory response in 2023 was shaped entirely by the memory of Lehman. When SVB collapsed, regulators initially planned to follow standard procedure: protect insured depositors up to $250,000. But over that weekend, as panic spread and another bank failed, regulators feared a systemic meltdown. So, in a dramatic move, the Treasury, the Fed, and the FDIC invoked a systemic risk exception. They declared that all depositors at SVB, insured and uninsured, would be made whole. It was a de facto bailout of every depositor designed to stop the contagion at all costs. The collapse of First Republic a few weeks later showed regulators refining their new playbook. Over the final weekend of April, regulators worked to find a buyer before seizing the bank. On May 1st, the FDIC announced it had taken control of First Republic and simultaneously orchestrated its sale to JP Morgan Chase. Once again, all depositors were fully protected. It was a clean, orderly resolution designed to project calm and prevent the chaos that followed Lehman. The contrast could not be more stark. In 2008, the government's tough stance on Lehman triggered a global crisis. In 2023, haunted by that memory, the government took extraordinary steps to guarantee deposits and contain the panic. The decision to let Lehman fail was a lesson learned the hard way. The response in 2023 showed that regulators would do whatever it takes to prevent a repeat, even if it meant rewriting the rules on the fly. We've just walked through the blueprint for financial disaster. From the reckless pursuit of growth to the final government seizure, the pattern is disturbingly clear. If you want to continue to understand the deeper forces that shape our financial world, make sure to subscribe and hit the notification bell. And let us know in the comments. Do you think the government did the right thing by guaranteeing all deposits in 2023? Or does it just encourage banks to be reckless again? So there you have it. The 6 stages of a bank collapse: rapid growth, asset concentration, failed governance, a trigger event, a run on confidence, and regulatory intervention. We've seen how Lehman Brothers, Silicon Valley Bank, and First Republic all followed this same tragic path. The names change. Subprime mortgages are replaced by interest rate risk. An institutional run is replaced by a digital one. But the underlying story of hubris, concentrated bets, and a failure of oversight remains eerily constant. This brings us to the most important and unsettling question. Why does this keep happening? Why do bankers, boards, and regulators miss this predictable pattern time and time again? Is it that the incentives in the financial world, the massive bonuses for short-term growth, the pressure for quarterly earnings, actively encourage the behavior of the first 3 stages? The system privatizes the enormous profits during the boom and socializes the catastrophic losses during the bust. The actions in 2023 prevented an immediate meltdown, but they also reinforced a dangerous precedent that certain institutions are too important to fail. This only raises the stakes for the next crisis. Because there will be a next crisis. And as long as the fundamental incentives that drive this 6-stage cycle remain in place, it's only a matter of time before we see another financial institution begin the long, predictable walk off the very same cliff. The only question is, who will pay the price next time?